hour long session because it didn't get turned off at the end. So you should see a little red button at the bottom that's like stop recording. If not, I can handle it on my end.
I don't, unfortunately.
Okay, so everybody, this is Mike Mnat Sakanian. Whew, I got nervous committing to saying it. And you've taught me many times, and I'm getting around to it. Like you wrote it on your deck, like on your PowerPoint presentation you're about to show us. You spelled it out, and I was like, that helped a lot.
Yep.
I met Mike at Amy Majuri, who's a great friend of mine. If you guys watch the OPM methodology, that's Amy Majuri in that course with me. And I met Mike at her conference, RPM, a couple of months ago. It's called Raising Private Money. It's a conference that's all about raising money. And we got to talking. We talked for a little bit. And then probably like, I don't know, 30, 45 minutes in, Mike tells me that he does creative finance. And I was like, bro, why didn't you lead with that? You got to tell me these things. We could have been talking about this the whole time. And I told him about this idea with Creative Camp where I'm like, hey, dude, I want to build like a really cool space for, getting deals out to people and helping them find deals and all that good stuff. We've had a lot of really good chats about philosophy of creative finance and underwriting it. And like, how does the Airbnb side come in? And I don't know. We tried to probably for like an hour the other night, just our own thoughts, bouncing ideas off of each other. And I was like, dude, you got to come in, talk to us about how you underwrite your properties. For everybody that's watching this, like, we've got pretty good steady deal flow in the creative deal pipeline right now, but I'm sure a lot of you are thinking like, okay, cool. I see deals in here. Are they good deals? Are they bad deals? How do I underwrite them? What do I do? What are the next steps? So hopefully in today's session, which we're calling Underwriting 101, we could give you a little bit of guidance on how to evaluate if a deal is worth pursuing. And then I have a coaching call tomorrow that's called Comping, the fundamentals of comping, or Comping 101. And I'll be talking about the actual short-term rental analysis side of it. But before we get into the short-term rental analysis side of it, I wanted to give a little bit of time and energy towards just what does underwriting mean? I know a lot of you in this program are like, a lot of you are excited. A lot of you are like, man, I'm excited, but I'm overwhelmed. I promise you, we have scheduled these coaching calls in as linear of a order as possible so that it's kind of a digestible path to finally closing your first deal. But with all that said, Mike, you're going to be talking about underwriting today. Before we hop into your presentation, can you just give us a little background about who you are, what you do, what kind of deals you do, your process, and then let's hop into like your philosophy on underwriting.
Yeah, if you want, I can actually start the presentation, which actually goes into that right at the beginning.
Perfect.
That'd be even easier for my visual people. They don't have to just hear me.
Okay. While you start your presentation, I'm just going to give a quick shout out and kudos to Sarah Howard. Sarah, you don't have to come up, but Sarah signed a contract today, or I think got under escrow with one of the deals that was posted in the deal pipeline I think a day or two ago. So everybody reach out to Sarah, say congrats, cool, you did it. And since when you're one of the first students, Sarah, we'll be doing a case study on yours, and I'll help you kind of analyze that and take a look at it. So congrats, everybody. We got the deals there. Let's get to closing. With that, go ahead, Mike, hit it.
Can you see the presentation?
Yes, I can. Let me maximize this so everybody can see that the most.
Okay, and then let me put you guys, I would like to see the people there so I can see you all there. Can you still see the presentation?
Yeah. Mm-hmm.
Oh, cool. Okay, awesome. So everyone, I'm Michael Manatskanyan. I'm a real estate investor. I'm a buy and hold investor more than anything else. I've done almost every single type of real estate transaction, and we'll go into those a little bit more. I am a wholesaler as well, although my main business is buying and holding real estate, not only for the cash flow, but all of the other benefits that come with being a real estate investor. Just before anyone asks, I know Rob likes to see it. So my last name, it's Manat Sakanian, right? Maybe that could be like an S-U-H. Manat Sakanian. In the Sub-2 community and other creative finance communities, I'm known as the creative engineer. And I'll talk a little bit about that, but I am an engineer by trade. But the main reasoning for that is something I specialize in is underwriting. My bread and butter is taking the deal terms, whether they're coming from a wholesaler, whether they're coming from the seller directly, an agent, whoever, and then seeing, okay, what do the numbers tell us? What picture does this paint for us? And then what do we need to potentially move around to still make this a deal? And at the end of the day, it's a two-way street. So the seller has to agree on our terms, or the wholesaler, whoever we're talking to. But I'm not going to buy a deal that I don't like or doesn't make sense for my goals. So my job is to, well, we'll get into that a little bit deeper. But I'm also the co-founder of Coast to Coast Vets. My business partner, Adam Catledge, and I are real estate investors. We buy and hold together, both veterans, live on opposite coasts of the country, and we own properties nationwide. And then Creative REI Calc. So that's my real estate creative finance deal analysis calculator. So getting into it, just high level who I am. So I like to make sure to say that I'm a self-made real estate investor. I'm a first generation. My parents, God bless my mom for working as hard as she did, but we did not have a lot of money as a single mom. And I've been able to currently have 42 rentals in our property. We're going to add dozens more this year, worth over $10 million, the real estate portfolio. I only really started in 2018. And when I say started, like a lot of you, starting means consuming information, listening to Bigger Pockets, even before we have our current podcast hosts. 2020, I bought my first property. It was a multi-family house hack in Fairbanks, Alaska, using my VA loan. Did the same thing with a 4-unit in 2021. Did a 3-unit in 2022. And then 2023, I really exploded in creative financing and purchased, 2021, I also bought my first 20 rental cabins. And those were seller finance. So that's when I got introduced to creative financing and wholesaling as well that year. 2022, house hack, got out of the military, moved to San Diego, and then just kept buying real estate deals in 2023 and hoping to do this, or planning to do the same this year. So as I mentioned, I still wholesale not actively. I used to wholesale very actively, dozens of deals a quarter, not a month, dozens of deals a quarter. But I primarily focus on buy and hold investing. I've achieved financial independence at 27 with 26 rentals while active duty in the military. So for those still working their W-2, I'd say, especially if you have a decent paying W-2, you're in the best position. I know people who make the leap to going all in on entrepreneurship and investing. I think it's really nice to have that safety net of active income to take care of yourself and your family while also building your real estate portfolio, because there is time to do both. As I mentioned, I'm an engineer by trade, chemical engineer in particular. There's a really good, my favorite mentorship that I'm part of is the Sub-2 mentorship with Pace Morby. And I'm a leader in the community, specifically focused on underwriting and crafting deals, helping people get their first deal, or helping buy and hold investors. And then I'm also an alumni for their mastermind community. I'm very passionate about helping others engineer their path to financial independence. So I don't just do real estate. I also wholeheartedly believe in index fund investing, and that's a whole nother part of my overall portfolio. And then my goal for this year is to help 100 informed investors achieve financial independence. And I really like to highlight informed investors. It's those who will go into acquiring real estate with a plan, and then the deals that they're buying fit their plan. A lot of people, unfortunately, buy real estate that does not. They try to do real estate deals that does not necessarily go with the goals that they've mentioned that they focus on, or that they're focused on. Primarily, if you're focused more on cash flow versus appreciation or tax benefits, there's so many ways to make money or save money through real estate investing. But without a plan, you're kind of just going at it without being intentional. And then informed in the sense that whenever you buy property, you have a pretty good idea what the returns of that property will look like. So that's really a big point for me. Okay, and just no better than, yeah.
Is there a sound for this?
Can't hear it?
Mm-mm.
Oh, it's all right. No worries. I was just going to say, no better than hearing from my top mentor, just highlighting my underwriting skills and all that. But we'll move on from that. So Joseph here is an investor that I helped buy his first deal, helped him analyze and helped him structure a creative deal on a multi-unit with a VA loan that was in place. And then he was talking to Pace, and they were just talking about. I figured I might as well link that in there. So
So
the outline of
basically,
today.
you're a badass at underwriting, and the top dogs have said that you're a badass at underwriting, and so you're the guy.
There you go. Your words, not mine. Yeah, but definitely, and it's something. I mean, the thing is, like, a lot of people get into paralysis by analysis, and there's a healthy amount of that you need, especially when starting out. I underwrote every single. I knew I wanted a house hack when I moved to Alaska, and I knew I wanted to use my VA loan for it. I underwrote every single multifamily deal, and even before I moved up there, I was underwriting every single deal because there's nothing better than understanding what are the typical returns in a market and then doing your best to exceed that. Like, that is the main intentionality of what you're doing, especially if you're investing locally. You have to know what your market returns are locally, and then what is a great deal compared to that. So that's a really big thing of mine. And it took me 2 years to buy my first deal, but every single deal that I've bought, it's panned out the way I planned it to, if not better. And that's really the goal you want. You want to create a fairly predictable business model. Things come up all the time, but you want to account for a lot of the issues, the reserves, you don't want to sugarcoat your expenses and underdo those and then overdo your income to then put $100,000 into a deal that isn't performing. And now you're spending all this time and energy on a property that's not performing and leading you to your overall goals. So that's why I focus so much on that piece, because that is the one piece we can somewhat control, or at least predict or analyze and have a pretty good I don't even know how to phrase it. You obviously can't predict it. Anything can happen, but for the most part, a lot of it is fairly predictable. And we'll
You can
talk
make
about that.
you can make an educated guess. I mean, I'm going to say this.
There
I'm
you
going
go.
to pipe in here because as someone who has bought a lot of deals, lots and lots of deals, most of them have been pretty good. Some of them have not been great. And the ones that have not been great have been as a result of shoddily analyzing or believing that I could beat the data and saying, like, look, the comps aren't great, but I can come in and Rob built this thing. And then it's like, well, it's a nice place, but it's in the middle of Kansas in the open field, and there's not civilization for 1,000 miles away. This isn't true, but I'm just saying, not every short-term rental badass can turn a dud into a cash flowing machine. I've got properties that I have made cash flowing machines as a result of having to overcompensate for not being as dialed in my analysis as possible. And it is a lot easier to just figure this out before making the offer, before getting into it, before closing on it. And just walking away before you close can save you so much time and money. And so it's really important to kind of get your underwriting hat on and taking it very serious.
Mm-hmm. Totally. So I appreciate that insight right there. And that's exactly it. Like, we couldn't predict what happened in 2022, where short-term rentals kind of, like, listings, like vacancies kind of just went up and prices kind of went down. And it's like, what's going on here? And yeah, there was economic factors. You can't really predict those kinds of things. But what you can do is you can underwrite the comps. Okay, what are the other properties in this area generating? And you guys are going to focus on that tomorrow. I'm not going to focus on comping at all today. We're going to talk about the key components of investment analysis in general, key components of underwriting specifically, and then creative finance underwriting principles. And then when I come next time, we'll get more into the weeds with actually underwriting creative finance deals, not the overall concepts. But I'm going to go on from here. So at a high level, I think you all know this because you're in Rob's community, a bunch of smart people who are ready to invest in real estate or have been and want to scale. But there's multiple ways to make money in real estate, right? There's appreciation, which I don't bank on. Well, I guess I do a little bit in San Diego, but that's something I don't underwrite for to determine if a deal is good or not. There's debt pay down. Every single month when someone is paying down the principal of your debt, a tenant is paying that. That is generating equity for you. You get the tax benefits, which I super appreciate living in California and having a W-2 actually. So I work a W-2 still because I get to work on something I'm pretty passionate about, protecting the environment and the community in San Diego. And then real estate helps me avoid all of the taxes because my wife's a real estate professional, helps avoid all the taxes, at least federally, in the state of California. So at least I could mitigate a bunch of my taxes, which is nice. But really, we're going to focus on cash flow. So your profit left over from your income after paying off your loan, expenses, and setting aside reserves. That's the main focus when it comes to underwriting. You do account for the other components of it, but it doesn't matter if your property is appreciating. Well, it could matter if your property is appreciating. If you don't have the monthly income to keep making payments on that property, right, to cover your expenses. I will say I have bought properties that I will lose a couple $100s, but I'm making thousands of dollars in equity, principal pay down, appreciation of phenomenal market like San Diego. But you don't want to build your portfolio on that. You want your cash flow and properties to incorporate those into your overall portfolio. Basically, your real estate portfolio, you're designing it that way. So then you have a healthy balance of cash flow and long-term wealth generating assets. But it's really hard to get to that point unless you have a solid amount of cash flow and assets. All right. So how do we determine a good deal? There's
really fast. Can I ask you a question on your last slide?
Of course.
Just a little bit of clarification for someone that may not understand what you mean by debt pay down. But you said, you know, I might lose some cash flow here, but I'm getting amazing debt pay down here. Can you quickly just run us through what that concept means for anyone that may not understand sort of that concept?
Definitely. So your mortgage, let's just say it's not a seller finance deal. You have a loan out on your property, and your mortgage accounts for your principal and interest of your loan payments, your tax payments, and your insurance. Well, your loan payment every single month, when you're paying on that loan, you are paying principal, paying down the actual debt of that loan, and then interest. You know, when they say 7% interest or whatever, the interest payments associated with that loan. As you move further along in owning a property, let's say the 30-year mortgage, the further along you go, there's an inverse relationship between how much you're paying, how much your principal is getting paid down versus your interest. When you're starting out paying a loan because of the amortization schedule, the payment is the same for all 30 years, but the majority of your payment up front is interest, and very little goes to principal. The further along you go into the loan payoff or pay down, you're paying down your overall monthly payment. More of it's going towards principal, less towards interest. So, for example, if I'm buying a deal that's 10 years into its loan payment or its mortgage, and the interest rate is 3% versus I'm just starting the loan out at 3%, you're paying that the property that's 10 years into ownership already of that loan, you're getting more principal pay down on that loan versus when a loan is just starting out. Does that kind of make sense? Like the time scale, the amortization, but also kind of the split between your mortgage payment or your mortgage payment and then your loan payment.
And so what you're saying is there are oftentimes or sometimes when you're underwriting a deal, properties that might lose, let's say $100 or $200 every month in cash flow, meaning you have to literally come out of pocket to pay it. But because you're making a mortgage payment that month, you're also bringing your balance down. And so while you're losing money here, you're actually paying off more over here. And so sometimes it's like a wash. Sometimes you're actually building more equity than you're losing in cash flow.
Yeah. So the debt pay down and appreciation really benefit more than anything your net worth, right? How much is your net worth increasing? Because appreciation of property value is going up relative to the debt. And then debt pay down, you're paying down the debt. So that's adding to your net worth, and someone else is making those payments. The problem with debt pay down, or when you have a property with equity, it's more illiquid, right? You can't, unless you sell the property or cash out refinance, you can't tap into that equity. Whereas cash flow is nice because that's money in hand every single month. You could do something with it. However, if it's there, if there's a good enough, for example, I have a property right now, a multi-million-dollar deal in San Diego. We lose around $1,000 a month on it in cash flow during winter months. We usually make it up. You know, if you seasonally adjust, it's neutral, if not positive. But we can lose as much as $1,000 a month in the winter months. But someone else is paying down the debt, the loan on that property. And at this point in the amortization schedule, I am getting around $5,000 a month in debt pay down. So for me, that's a fair trade. I'm losing $1,000 of cash flow. I'm putting that money, I'm losing that. I'm paying it to the on the loan, but I'm generating $5,000 a a month in principal pay down alone, at least. And every month it goes higher and higher. So that for me is a good trade-off at this point in my investment journey. For the first 26 properties, I wouldn't have even considered that. I needed to build my cash flow foundation before I even considered trading away cash flow for equity or
Sure.
appreciation.
Cool.
Yeah.
Makes sense. Thanks for
Yes,
clarifying.
sir. Yeah, of course. I appreciate that. So any more questions when you guys have them, please ask me because I'd love to clarify those kinds of concepts. Okay,
If
so
you
how do we, yep.
if you pay in like after 10 years more of not the interest, then if you do refi, you can get more money out of it. This is what it means. Uh, like if you pay interest, you can get it's not like every month you can take a higher refi. Only when you pay the principal. Does it
When
matter?
you're paying your loan payment, it's already principal and interest payment. So if you ever look at like an amortization schedule, which is basically, you have a loan for $100,000, and let's say your payment is $500 a month for that, and then 30 years it'll be paid off. In the beginning, $450 of that will be going towards interest, where $50 will go towards principal, paying down the actual loan itself. But the payment is $500 the whole 30 years you own the loan. But the further along you go in paying off your loan, more of it goes towards principal, right? So maybe after 10 years, 15 years, it's, and I can show you guys an amortization schedule later if needed. But the principal payment becomes more of the monthly payment of the $500. More of it is going towards principal pay down of your loan. And then less of it is going towards interest. Banks do that. Well, we don't need to get into that either. But yeah, the only way you can tap into that is if you sell the property or you cash out refinance. It adds to your net worth because now you have less debt on the property. But the issue is it's illiquid. It's harder to access. It's like a bond kind of where it's growing in value and it's there, right? But it's harder to do something with it. I guess you can't tap into it as easily. Where the monthly cash flow, you're getting that every single month. That's hitting your account, and you can reinvest with that. You can do whatever you want. But in that scenario where maybe I'm losing $1,000, but I'm getting $5,000 to my debt paydown, for me that's a fair trade-off. If I was losing $1,000 in cash flow to make $1,000 in debt paydown, that wouldn't make a lot of sense for me. I need a significantly higher return from that one component. And a multi-million-dollar deal in California is going to go up in value. Obviously, especially in San Diego, over a long enough time period, and I was able to get into it with very little money down, and it adds for another variety of other reasons. It helps me with content, marketing, whatever, all that other good stuff. You can't really put a tangible value to, but I was just trying to show an example in which you could exchange a loss in cash flow for the other benefits of real estate, but most people should be focused on cash flow when they're underwriting deals.
Yeah, especially at the beginning of your journey too. I have so many deals in my portfolio now where I can sort of make those judgment calls if I need to. Is it worth it for me? But when you're starting as an investor, most of the time, cash flow is the most important metric for, I would say, the majority of newbie investors looking to break into this, because we're trying to, build $1,000, $2,000, $3,000 of cash flow. So when you're looking at a deal, as you get kind of further along your investment journey, cash flow becomes less important than equity and appreciation, and it's kind of one of those things that your philosophy on this will change as you evolve as an investor. But I would say, would you agree, Mike, that cash flow is kind of like, I don't know, the number one metric getting into it versus maybe like 10 or 15 years into the journey?
100%. And I would say less on the timeline of how long you've been investing, but more on once you have enough monthly cash flow to not only sustain your lifestyle, but then also to sustain the ebbs and flows, the volatility of your rental portfolio. It's not it took me it only took me 3 years before I started focusing on these other benefits of real estate investing, but it took 26 rentals. And even now, it's maybe for every 10 good cash flowing properties, do I buy one focused more on the other benefits of real estate,
Sure.
So it's you really still want to be very conservative. The main thing you should be focused on is cash flow. Is your property paying for itself? Whatever money you have to put into the deal, are you getting a good enough return on that? And that's kind of the next few slides.
Love
So
it. Yeah.
I think we'll
Let's
leave
get
it at
into it.
that. This is excessive for this piece, and we could show that later. But cash
Yeah.
flow is the main focus for real estate investing, especially starting out until you have a very solid portfolio.
Sorry. I'm always like, hold on, let's talk about this is good stuff, but I'm
No,
not
it
going to
is
throw
good.
any more wrenches in your motor.
No, you're good. And I know we like to talk about portfolio design or architecture and all these things, looking at your portfolio holistically, not property by property. But for the majority of people, till you have several assets, or it doesn't even matter if you have a ton of cash flow, $5,000-$10,000, that's when you should start considering focusing on more appreciation, debt pay down, other stuff like that. But for now, let's focus on what determines a good deal for when you're focused on cash flow. So there's two key metrics for analyzing investment properties. I think you all know this or should know this. If not, let me know. But the two key metrics are cash flow, right? So it's basically your monthly profits. It's your income minus the fixed expenses you pay, and then the reserves that you're saving for. That's your cash flow. And then your cash on cash return, the second key metric, is your annual cash flow. So 12 times your cash flow, right? Divided by the money you invested into the deal. All right, we'll get into both those as we go throughout the next few slides. But cash flow is your monthly profit, and cash on cash return is your annual profit, right? Your monthly profit times 12 divided by how much money you have to put into the deal. And I'll go into those further. But once again, your cash flow income is just rent, fees, whatever else you're charging for your short-term rental income. Your fixed expenses are typically going to be loan payments, unless you buy property cash, which is not the focus of this. But your mortgage and loan payments, tax payments, insurance, utilities that you're responsible for, property management. I put 10% here for long-term rental. Even if you're self-managing, it's good to account for that, because at some point you're not going to want to manage it. And then your reserves. Once again, it's a little different. So comping tomorrow is going to be very helpful for you guys to understand your occupancy rate for short-term rentals. But for long-term rentals, you typically say 8% vacancy, which translates to around 1 month a year. Your property's vacant, you're saving for that month so you can still make payments. And then maintenance and capital expenditure. So you should be accounting for that on your short-term rental. I'll leave it at that. So your cash flow equals your profit, right? I think most people understand that concept. That's the main reason people get into the real estate investing. But cash flow only takes you so far. You want the money that you invest to work hard for you. So if you cash flow $100 a month, that could be great, but it's very different if you have to put in $12,000 to make that $100 a month, or $1,200 a year, or if you had to put $120,000, right? That's the difference between a 10% cash on cash return or a 1% cash on cash return. I think I'm pretty bad at math on the fly. I use calculators, but that's where cash on cash return comes into play. So cash on cash return is your annual cash flow, right? Your annual profits divided by the money you invested. The higher your cash on cash return, the better. Here's a more understandable, like your return on investment. The higher your return on investment is, and your initial money invested, and we'll go into that more with creative deals, but this is typically your initial money invested when you're buying a property conventionally. You have your down payment that you have to pay. You have to pay some agent commissions, unless the seller covers it. You have your closing costs that you're responsible for, and then whatever other rent-ready repairs you need to include. So maybe you need to spruce up the property and then furnish it. Those would all be part of your initial money invested. So it's your annual profit you expect divided by all the money you invested into that deal is your cash on cash return.
Do you have this cash on cash return mathed out for them? Just so can I throw out a math example so I kind of understand it a little bit clearly?
Yes. What do you mean by that?
Okay, so just so people understand, because it may be a little confusing to not contextualize the equation.
I have numbers later, but
okay, cool, got it.
But it's more for entry. It's more for creative.
Got it. Okay.
Yeah. Okay. Cool. So returns. What returns should you look for? And this is something I always include with these types of trainings. Like, it totally depends on you, your investment portfolio. I always look for a cash flow of $100 per unit, right, for long-term rentals, because if it makes less than that, it's almost not even worth the time, unfortunately, unless it's in a great market. And a cash on cash return of 10%, because I know I can invest into the S&P 500 super passively, not do anything, and over a long enough time horizon, I'm going to get 10% growth on that investment. So those are my specific requirements, what I look for. It's ultimately up to you what you're looking for.
Yeah, I'll add a little color to this. I mean, I think a 10% cash on cash return is like you said, it's good. Couple of intangibles, right? Is that, let's say something's a 10% cash on cash return, but you get a really massive, because the thing is, the way I look at it, Mike, and tell me if you disagree, but from a philosophical standpoint, there's like two really big things to look at. There's the cash on cash return, which is like how hard your money is working for you in a year's time. So if you make, let's say you invested 100K and you make $10,000 that year in profit, then that's a 10% cash on cash return. That's how hard my money worked for me in a year. But then there's ROI, and ROI factors in those other 4 components that you talked about, right? Debt pay down, tax benefits, appreciation, and cash flow. And that's the total ROI. So a cash on cash return might be 10%, but the ROI could easily be 20 or 25% when you factor those other things. So just a note to everybody that at 10%, even if it's a little less, there are some other intangible things to keep in mind. There are a lot of people in here that are like, dude, I want to do this because I want to save money on taxes. I don't really care about the cash flow. Well, in that instance, the ROI could be super high for you because of the tax savings. And I always like to add that. And then you said $100 per unit. That makes a lot of sense from a long-term rental capacity. But for anyone that manages short-term rentals in the group, you probably could quickly say, yeah, $100 of profit per month on a short-term rental is probably not worth it for the amount of work that goes into it.
Especially if you're self-managing it. I mean, that's assuming when I say cash flow, I'm talking about you are paying a property management company, you have maintenance and capital expenditures, like you're saving everything. You're saving all these reserves.
Cool.
And it's still generating that cash flow.
Yeah.
Because if you're working for $100 per unit, that's a lot of work. And as you mentioned, ROI is a phenomenal metric that accounts for all the other benefits of owning real estate, not just the cash flow. That's all cash and cash return is looking at, is your cash flow divided by your entry costs. And the cool thing is your ROI is always going to be higher than your cash and cash return, because your cash and cash return or your cash flow is also included in your ROI as one of the benefits. Yeah. So you're always going to have a higher return once you account for, let's say, 2-3% of appreciation. Let's just say a few $1,000s in principal pay down. Depreciation, like I said, for me is huge. I save tens of thousands of dollars from taxes every year. Like 1 or 2 properties helps me mitigate all of my taxes. So it really depends on what you're looking for. But knowing that cash and cash return is the lowest return you'll get, ROI is going to be significantly higher when you account for the other benefits of real estate investing. Some of our partners on deals, they solely join us to buy the deal for the tax benefits. If we give them the tax benefits, and then maybe they're not so focused on the cash flow, because $1,200 a year might not mean anything for them, but that the huge savings and other benefits of real estate are valuable. Cool. So it's tough to have good cash flow or cash and cash return with 7% interest rates, right? I think whether it's a long-term rental, mid-term rental, short-term rental, it's tough. And especially if you're doing DSCR loans, I know people were in the 9-10% just a couple months ago. I think, it's lower now. I was able to refinance a property. This is owner-occupied VA loan, so it's pretty solid, right? It's one of the best you're going to get, under 6%, which is amazing. We're already back down a little bit. But that same one would have been in the 2s, a year and a half ago. But just, it's a lot harder to make deals work when interest rates are high. And that's where creative financing comes to save the day. So the reason why creative financing is much more beneficial than traditional financing, at least in this market, is because you get to, if it's a seller finance deal, you have control, you and the seller have control of how you're going to structure the deal. Just because the bank says you have to put 25% down at 10% interest doesn't mean the seller is going to need that. Subject to, or buying a property with an existing loan in place could be really beneficial, even if you're taking 5, 6, 7% interest rate loans, because you might have to put in a lot less money to buy that deal than you would otherwise if you had to put in a significant amount of money down to acquire the property. And you don't have to deal with the hassle. I don't know about you all, but I absolutely hate going through the process of using banks anymore for financing. It is such a hassle. Even with refinances, you know, I've done whatever. All that, there's so many benefits to it. And the main one is you're typically able to structure better terms than you can with traditional financing in the current interest rate environment, like in the current bank lending environment. Because when interest rates were low, Rob can talk about this, I'll talk about this, we would buy tons of deals with bank money, DSCR loans, every type, you know, 10% down, second home, whatever. There was a lot of great ways to get great deals with conventional financing, traditional financing, when interest rates are 2 to 4%. Very different ballgame now. And I was still able to add another $6 million in 15 rental units last year, all through creative financing, even though if it was just traditional financing, it would have been really tough for me to be able to do so.
Let me clarify, because that's
Yeah.
a big scary number, and I think a lot of people might hear that and say, whoa, like that's crazy. Let's break that down a little bit, because basically when you say that you acquire $6 million in real estate, that basically means that is the total portfolio worth of that real estate. It doesn't mean that that's how much equity you have. It doesn't mean that if he sold that $6 million of real estate, he makes $6 million. But the idea is he's assets under management, AUM. You might see that every so often. The assets that he has under his management, his portfolio, all that good stuff is worth $6 million paid off. And so in 30 years, when other people have paid off his portfolio and he sells all of it when he's 65, he's going to get a check for $6 million, except it will have appreciated, it will have doubled or tripled. And so probably on that $6 million that you have today in real estate, if you just let people pay it off for you, that you acquired all of this creatively with very little money down, 30 years from now, you'll probably get a check for $12 million at the closing table because of appreciation, because of debt pay down and all that good stuff.
Yeah, so you'll get benefits from the appreciation, from the debt pay down. You'll get, the way I'm underwriting my deals when I'm acquiring them, I'm getting cash flow each month. You're getting all those benefits. And that's a great point, Rob, because for the most part, I have very little equity on those properties because there is a give and take with creative financing deals. You have to, both you and the seller have to give and take a little bit for the deal to work for both parties. Typically, my focus is what terms do I need to get this property cash flowing? And typically the main thing I'm giving up to the seller is I'm buying it at fair market. I'm buying it at retail prices, maybe even slightly above retail prices. As long as I can cash flow, I can make more money each month than I'm spending. That's the deal I'm trying to structure. Not, okay, can I save $15,000? I'm getting some equity up front. So on that, I mean, to be fair, we also do rehab and, our properties do increase in value, but let's just say I have no equity in that, let's say 6 million of it from the last year. My main focus is making sure the portfolio pays for itself. That's the goal. So then I can let all the other benefits of real estate investing work for me, like Rob described, over time, all those other benefits. So that's something you have to consider when you're accounting for creative financing. You're typically not going to get it at a lower price than the property's worth. You're probably going to pay slightly more than it's worth, but it could still work for you as a great deal because you might be able to get into it with little to no money down. You should be cash flowing on that property, especially if you're incorporating a short-term rental model. So yeah. And then hybrid is the last one we're going to focus on. And that's just a combination. Most deals have a component of subject to and seller financing. For example, if the property is worth $500,000 and there's no loan in place, well, we'll go through those examples right now, actually. So yeah, these are the three we'll focus on. So seller or owner financing. This is when you basically recreate the seller in this instance becomes the bank now. But instead of you going to a bank and the bank telling you, okay, I need 25% down and here's your interest rate. Now you and the seller, the new bank, are able to structure the terms of the deal. This is only possible when the seller either owns the property, $500,000 property, fully outright, or they have a small enough mortgage or debt in place that you will pay off as part of closing. Those are the two scenarios in which you have full owner financing. So either you're paying down the remainder of their mortgage or they own it completely outright. And then you seller finance, you structure the rest of the deal. And the components that matter for seller financing, create this little table, took what I have and then made this little table for y'all. The main components of it are the purchase price, the down payment, what I call the monthly payments. I specifically don't focus on interest rate, amortization years, things like that. I focus more on what is the payment that you're looking for seller when I'm negotiating with sellers. Because if you start throwing around interest rates and all this stuff, it starts confusing the seller. All they typically care about is, okay, I have a $240,000 property. I want 10% of that down, and I want $800 monthly payments. I will then adjust the interest rate and the terms, the amortization terms on that deal to make it hit the monthly payment that they're looking for. And then the balloon. Typically, if someone, and the balloon is simply put, like, let's say it's a 30-year loan, the payments, it will take 30 full years to pay off that loan. Well, sometimes the seller says, okay, I'll let you make payments as if the loan will be paid off in 30 years if you just continue making payments for 30 straight years. But at the end of year 10, I want the whole remainder of the loan paid out to me. That's what a balloon is. You have to pay out the remainder of that loan to the seller, or you can refinance the property and then take out a new loan to pay off the seller. You can pay them with whatever other source of money you have. You can sell the property and pay off the seller, whatever. But they're saying, I'm only giving you this loan for this number of years, right? And typically what I found is sellers care more about the purchase price. Well, this is what I mean by there's a give and take. There's a couple levers to structuring these deals. There's the purchase price, there's the down payment, right? And the difference of those two is the seller finance loan. And then there's really the monthly payments and the balloon. So when I'm structuring a deal with the seller, I am negotiating, the seller could want all four, they could want 300,000 and 25% down and, an unreasonable monthly payment and a short balloon. But as the buyer, you also have to determine, does that make sense for you or not? Right? So that's what seller financing is. Subject to financing is you're buying the property with an existing loan in place. When you buy the property from the seller, you're going to be the owner of the property. Your name is on title. However, there's still a loan in place under the seller's name. This is less flexible when it comes to renegotiating the deal, because with the loan in place, at minimum, you have to keep making that monthly payment on that loan, right? You can't really change that with a bank. That loan is already in place with the bank. Where it says here, the original loan amount was $184,000. The interest rate, the 30-year amortization, and that leads to $1,163.30 a month in principal and interest on that loan. You're going to have to pay that no matter what as part of this transaction. However, if the current loan amount is $184,000 and they're trying to sell it for $250,000, that difference, the $250,000 minus the existing loan of $184,000, that difference, that's where you can negotiate. But the thing you can't negotiate on is the monthly payment of the principal and interest loan. Like at minimum, you have to make that payment for sure. And that's when we'll get into hybrid. In this scenario, right? It's basically you're buying it for the purchase price of the loan for the $184,000. Let's say you're buying it for $190,000. You're taking over $184,000 loan, and you're giving the seller $6,000 to buy the property because, why would they do that? Maybe they don't have a lot of equity and they need to move. They had a job transfer. They lost their job. They're in a divorce. Some situation came up that's forcing them to sell, and they can't sell it at the price they need to conventionally, or they need to sell it quickly. So they're willing to give up their loan, even sometimes for no money out of pocket. I bought a few deals where the seller ends up with nothing, the agent ends up with a small amount, and I'm just taking over their loan because they're losing money because they're not landlords. They don't know how to set up a property, rent it out, and do all that. They're just paying the debt, and they can't afford to keep paying the debt.
Yeah,
Cool.
or they
Anything else
might
I can
just
add to that?
yeah, I mean the quintessential one that always seems to be the most common is someone loses their job or someone gets relocated and they're like, shoot, I got to sell this house. And oftentimes they don't anticipate selling it as quickly as they have to. And because of that, they are going to have to come to the closing table with 5, 10, 15 grand to pay out closing costs, commissions, all that stuff. And so it's just a more win-win situation to go up to someone like Mike and say, yeah, you can take over for me, get this monkey off my back kind of thing. And then now Mike has a property that he gets to hopefully operate better or run as a long-term or short-term rental that will cash flow.
Yep. And this is the most common motivation that we're dealing with right now because of the current state of the economy. Because typically when you bought a property a year ago, it would go up in value. Whether because interest rates were low or just property prices were going up. Now, as property prices are stagnant, if not some locations negative, and interest rates have gone up, so it's even harder for people to make those payments. It's a very common thing where someone has little to no equity, and when they have to sell the property, like Rob mentioned, they don't have the equity to be able to sell it and either come away with some money or maybe even make no money. They actually have to come and pay money at the closing table to cover the agent commissions, some of the repairs that were needed, whatever it is. And that's a very common motivation right now. And that's typically where you're finding the straight subject to financing deals, where there's no equity. You're just paying the seller something, maybe nothing, just to get them out of that. Yeah, Roy?
So most of the time in this situation, you don't even pay the seller anything else than the down payment. You don't like have a monthly payment to the seller. Like what happened usually? You just get the down payment and that's it.
Yeah. So let's say let's say they have a $184,000 loan and you sell and you buy the property for $190,000, right? There's that $6,000 that you'd pay the seller. But if you're buying at $184,000, there's no money to pay the seller. However, but you do have to account for the other costs of acquiring the deal. For example, there might be, if the seller has no money if they don't want to lose money to sell this deal, you're probably going to be the one responsible for covering the closing costs. That's very common in creative financing, where the buyer will cover the closing costs, where the buyer will pay the agent, where typically in a conventional transaction, the seller pays for it or the seller provides you credits. That's because they do it out of their equity. In this scenario, they don't have equity. They don't want to. The reason why they're willing to sell creatively is typically because they don't want to spend money on selling this property, but they don't want to be responsible for it anymore. So typically as the buyer, you're going to have other costs associated with acquiring it. And we're going to get into that with the entry costs of real estate owner or of acquiring creative deals.
The seller don't have equity because he only pay interest in the beginning and he just have the down payment and it's not enough for selling it and making money because he pay just interest rate in the few years. This why?
It's typically they bought it much less than a few years ago. If you bought it in 2020, 2021, you probably went up in value. But if you bought it in 2022, 2023, there really isn't much equity. Not only because, like, one thing to consider is you pay fees when you buy the property up front, and then you're going to pay more fees when you sell the property. So those fees, that's why they say, like, a typical thing you hear is you pretty much, like, you shouldn't buy a property unless you're going to hold it for at least 5 years. That's because the fees eat up a lot of it. And that's like a normal market, right? The last 5 years have been insane what's gone on. But right. in a normal market, it takes several years for you to even really make anything to cover all the fees you paid up front to buy it and then the fees to sell it afterwards.
Yeah,
right? So they just held it for such a...
Yeah, like going to that point, Roy and Mike, think about it this way. There are a lot of people that buy FHA loans, and that's a 3.5% down payment. There are a lot of people who use VA loans, and for VA loans, Mike, if I'm not mistaken, sometimes you can get into a VA loan with 0% down, right?
No, more often than not, you get into it with 0% down, and you roll some of the closing costs into your loan. So let's say you bought the house for 184. your loan might be 190 because you have a funding fee with the VA loan. And like I said, I'm prior service military. I've used VA loan and help a lot of people out of sticky situations with VA loan. So this is really my specialty is VA loans. A lot of times people roll some of the closing costs into the loan. So now they're really underwater. That property that they bought for 184, they owe 190 on. So not only are they already negative, a year later. I mean, that's a very common one. And yeah, they start off underwater from the very beginning because of rolling closing costs.
And the amount of principal that they pay down in the in 2 years is like $2,000. They will have paid $50,000 in interest. This is exaggerated, in like $10 relative in principal. That's the crazy thing. When you look at your amortization schedule, you'll see interest is like, if your payment is $2,000 a month, so you pay $24,000 a year. Let's say interest is usually going to be like $22,000, and then your principal pay down is like $2,000. It's all relative to the actual deal, but that's how it usually shakes out at the beginning of this kind of stuff. And so there are a lot of people who have not had enough time to pay down their principal, and they're upside down. And it puts them in a really tough situation because they got to get out, but they lose money. And not everyone has 15 grand in their bank account or 10 grand in their bank account to absorb those closing costs.
Mm-hmm. I would say the majority of people don't, unfortunately, especially when you're getting into a property with a VA loan or FHA loan. As someone who's used them three different times, FHA loans and VA loans, right? The combination are, a lot of people don't have a lot of money, so they're forced to use the FHA loan or VA loan. Although there's a lot of benefits to it. For me as an investor,
of course.
Little to no money down, but sometimes people have to because they can't afford a higher down payment. It's not even an investment. It's just, went wrong for them, unfortunately. And then next time, if you want, we can actually play around with an amortization schedule, especially on seller financing, just to see how adjusting certain things, how that affects how much interest is being paid and principal, and then how little goes towards principal versus interest, especially at the beginning. So you guys can get a better understanding of this. This one is really a 101 kind of intro to creative financing. And then hybrid financing, which is the most common. It's usually a combination. If you buy a property for $500,000, typically the seller bought it 3 or 4 years ago, and they bought it, at $400,000. They paid it down to $350,000. Well, they still have that $150,000 of equity, right? The $500,000 they sell it at, and the $350,000 loan. The $150,000 difference is their equity, and either you can pay them out. Like if they sold it traditionally, what would happen is that $500,000 that they would get would pay off the loan first, and then they would cover all their fees and stuff, and then they would then keep the remainder of that, a portion of their equity. In this transaction, it's similar, but instead of paying off the loan, you're taking over responsibility of the loan, typically because you're buying it at a higher purchase price or because you're going to cover more of the closing cost or something, right? People don't do creative financing. They don't sell their property creatively, typically, if they can just sell it conventionally at the price they want. Or especially, why do cash offers beat conventional offers? Because it's more seamless, it's more straightforward. And same goes for conventional but cash offers are typically less than a conventional offer would be, typically. Same with a conventional offer is typically less than what a creative deal could be, but it's a smoother transaction for the seller, and they don't have to worry about that property or that loan anymore, and the new buyer. But if they can sell it at the price that they want, they're just going to sell it conventionally. If they cannot, or something else is a motivating factor, then creative financing becomes an opportunity. And a common one is, besides those low equity ones, it's this combination of seller financing and subject to financing. And it's simply because that, as I mentioned that example, $500,000 home, $350,000 loan, and then there's that difference. Some people want to get cashed out that $150,000, then it would just be a straight subject to deal. Or maybe they only need $50,000 of that $150,000, and then you structure seller finance terms for that remaining $100,000, right? So then you're paying the monthly mortgage here that was existing on the sub 2 side on the right, and then you also have to pay the interest or the seller finance loan payments here, right? So it's a combination of those two. So you're paying them the existing loan plus the seller finance. You're paying both of those. Do y'all have a pretty good idea now between sub 2, seller financing, and hybrid? I feel like this is foundational for all the underwriting that's going to come over the next probably several months. You all will be working on.
Yeah, this is good. I mean, it's nice because we've covered these topics in some of the other calls, but actually seeing how you have it illustrated here is really nice. And I'll say more than likely, yeah, hybrid financing is going to be the most common version of this, because if you're talking to someone that bought their house in 2020 or 2019, they have equity. And so you got to figure out, a lot of people walk away from deals because they're like, oh man, the seller has $100,000 in equity. I guess I can't make this deal work. And it's like, no, you still can. You can still take over the mortgage. You just have to account for that extra seller finance portion that goes on top of the PITI.
Yep. And unfortunately, hybrid deals don't work so well, right? Unless you're taking over, because now you're paying, now you're paying the monthly loan. Even back in the day when interest rates were 2, 3, 4%, the majority of properties still weren't good investments, right? So now that we're able to recreate that and have to pay the seller monthly payments plus a larger down payment for their seller finance loan, like that's the hard part. That's why it's so important to not just buy a deal based on a 1% rule, or there's no shortcut to it. You have to truly understand at minimum what your monthly loan expenses are and what your income is, and then account for all your other expenses and reserves. There really is no shorthand or shortcut. What I will say is if your monthly payments for your debts are higher than what you can get in rental income, don't even waste your time underwriting that deal, because you haven't even added the other expenses or reserves, and it's already not a deal. You're already negative. It's not going to get better once you add everything else. That's my shorthand, quickly filtering, because our job as investors is not necessarily the main job of us as investors is to be able to quickly filter our properties, because there's so many options and opportunities out there. Our job is to filter out the noise, the things that don't work, so that we can really focus on those that do work. Because if we're spending so much time trying to underwrite everything fully, you're setting yourself up for failure because you just don't have enough time for that. But also, what you don't want to do is circumvent underwriting and then put yourself in a bad situation. That's definitely what you don't want to do. It's better not to buy anything than to buy a bad deal.
For sure. Yeah, that's really going to be the mantra here, guys, is like, we've got a lot of deals that are going through the deal pipeline now. I think we did like 30, we posted 30 deals last week, I want to say. And the best skill that you guys can have as a group is back of the napkin analytics. You guys have probably seen me do this on the call, and I think everyone's always like, how does he do this so fast? But like, you have to get really good at like very quickly looking at a deal to just even see if it's worth your time. For example, what's the PITI on this? 1163 plus you got seller finance, which is another 184. Okay, so your total payment on this is let's call it 1,300. Yeah, great. So for me, here's how I do this all the time. All right, you guys, this is the fastest skill that you're going to learn, and the most important one. You're going to say, all right, $1,300 is my mortgage. It's a 3-2, so I'm probably going to spend $200 every cleaning. My average amount of guests per month is 5 to 7. So let's say six guests every month times 200 is $1,200. That's how much I'm spending in cleaning. And then my utilities on that are probably going to be about $600 a month. And then miscellaneous expenses and supplies and random things, maybe a refund here and there. All right, that puts me at 2,500 plus 1,100 is 3,600.
36.
Great.
Yeah.
All right, so that doesn't even include vacancy. It doesn't include vacancy isn't as important in short-term rentals because you're using occupancy rate, but it doesn't include maintenance. It doesn't include reserves. It doesn't include CapEx, anything like that, right? Property management. But at a minimum, to run that property, the one that this pseudo property deal you have right here is $3,600 a month. And you multiply that times 12 times 3,600, $43,200. All right. I just did a very quick back of the napkin calculation on, all right, this is how much it costs me every year to run this property at a minimum. And there's other costs associated with that. Now I got to go into AirDNA. I got to go look at my comps. I got to say, all right, am I going to make a decent amount more than that? Yes. Okay. Let me underwrite further. Let me analyze further. If you go into AirDNA and that property, all the other properties and comparable properties gross $30,000, well, then I already know I'm going to lose at a minimum $13,000 every single year. So this is like a skill that you just got to like really, really hammer. We're going to be scheduling a lot of these comping calls to kind of build that muscle so that when these deals are coming through, you can quickly comp them out and see if it works for you as a long-term rental, as a short-term rental.
And that's
sidebar there.
For sure, we're comping. Like comping is the most that is the hardest part of underwriting, because comping is understanding fairly closely what your rental projections are and then what your expenses are. And the most challenging expenses are sometimes, well, there's a lot of challenges, but utilities are a tough one unless you have a profit and loss statement from before and it's operating similar to what you want. And then taxes and insurance, right? I don't know if you accounted for those here, because we're just talking about loan payments here. So once you account for tax and insurance, it's much harder, right? So this sub-2 loan calculator right here, it's focused on the principal and interest of the loan. There's still the tax and insurance as well, which are a huge issue.
Yeah.
So,
I was usually in that instance where I'm doing that, I'm doing all PITI, but even that kind of stuff changes a little bit too.
Mm-hmm. And let's say in that scenario, creative finance deal, conventional deal, it doesn't actually matter. You're still doing the same thing to analyze a creative deal that you are a conventional deal for the most part. And I'll clarify that. You're still focused on your income minus your expenses, including a creative loan or a new loan or whatever, minus your variable expense or your reserves. And your cash on cash return is still the same thing. Your annual cash flow divided by your entry costs, right? So it's a slight difference because there are different entry costs typically with creative deals, more with wholesaler deals that you have to account for that you typically won't when you're buying conventionally. And so we'll skip past that. Okay. So when you're buying a conventional deal, like we mentioned, if you're the buyer, right, you have your down payment, the seller is going to cover potentially at least their agent commission. You're going to cover, maybe you're going to split closing costs. Then you have like the inspection, whatever, and that's part of your closing costs, all that stuff together. That's really the majority of what you are paying. When you have a creative deal, it's a little different, right? You have that down payment to the seller that we talked about. You have to account for that just the same way you would if you were doing a conventional deal. You have arrears or liens, and this is if the seller is behind on their mortgage payment. They have like a solar lien, construction lien, something that needs to get paid off or taken over. Typically in this scenario, you have to pay that off before acquiring the property. If you are the one responsible for covering the agent commissions and the closing costs, you have to account for those costs. The same as a conventional deal, if you have to renovate the property, furnish it, whatever it needs to be considered rent ready, there's the closing costs. Typically in a creative deal, you are paying the closing costs. Even in a regular wholesale cash deal, you're the one responsible for those costs because the seller says, I want $300,000. They don't really want to. Sometimes it's negotiated into the deal, depending on how the deal is structured. Typically what you'll see is you're covering the majority of these things. I like to include for myself, and I include this conventional or not, admin, marketing, and exit costs. Really for me, it's an admin cost. It's my LLC formation costs when I'm buying a property on a new LLC. And then inspection costs, like the $550 or whatever it costs you to get an inspection on the property, or it's in the closing costs, whatever. I included my admin costs separately. An assignment fee. So when you're buying a deal from a wholesaler, that wholesaler went out there and structured a deal that they spent a lot of time and money to be able to filter out hundreds, if not thousands of people to find someone to provide this deal. So you're paying them for their time on that. Similarly to how you would pay an agent, and maybe sometimes you're paying both the agent and the wholesaler, but that's the wholesaler's fee. And then carrying costs, which I like to account for, conventional, traditional financing or creative. It's at least the first 3 months of expenses saved as part of my entry cost into the property.
Let me see if there's anything in here. Carrying costs. Yeah, carrying cost is a big one, because remember, when you buy a mortgage conventionally, you typically have about a month and a half before you have to pay your first mortgage payment. But then when you do sub 2, you're literally taking over at that moment, meaning the first of the next month is when you have to buy that next property. So when you buy a sub 2 property or seller finance property or a hybrid, be prepared to be to pay that first payment super fast. You don't get that same wait time that you do when you buy conventionally. Closing costs, do you have like an amount that you allot for your closing costs on a creative deal? Because it's usually a
I
lot
say like
less than
2-ish
buying.
percent.
Okay,
Yeah, I
cool.
say 2-ish percent, but that's not accurate. It's always been less than that, especially the bigger the deal, the lower the percentages. Typically I'm between $6,000 to $20,000 at the highest. And that depends on depending on the state you're in, if you have attorney fees and all these extra fees in addition to just like a regular title company. If you're going to account for include an escrow company, you're paying a transaction coordinator, right? There's a couple things in there. Rule of thumb, we do 1% to 2%.
And yes, it is based on the amount of the loan, Jessica.
Yeah. And that's the weird part, right? We do it as a percentage of the purchase price, but it's all just a rule of thumb for that one. Like I said, typically it's been between $6,000 to $20,000. If you're buying $1 million property, I guess that'd be 2%, 20,000. Yeah, I guess that's fine.
20 to 30K. Yeah. If it was 2 to 3% on $1 million.
Creatively, I mean, conventionally, correct?
Conventionally.
Because creatively, it's always been, lower for me, especially because I separate out a lot of these from closing costs, right? A lot of people conflate their closing costs with their cash to close, right? And that could account for down payments, agent commissions, whatever. That's not the case here. It's just the separate closing costs. It's your attorney fees and like we just bought a deal in Washington, and there's what's it called? Like an excise tax or whatever, and it's based on the purchase price of the property. You have to pay an additional. It's like a sales tax kind of for like buying the property. Let me see if I can answer any more questions based on the amount of the loan. Okay. So that is what I brought you all today, is to explain the 3 different acquisition strategies that are the most common for creative financing, understanding that it's really not very different. Once you understand that the loan payments are fairly, it's kind of the same thing. You just account for it in your cash flow as another expense, and you're dividing by your entry cost, the total entry costs, right? Here's a little nuance. It's a little different. Once you account for these entry costs, that's how you can analyze, does this property cash flow or cash and cash return? Because all the cash flow is, and Rob's going to go into that more tomorrow, the most important part for you all is to comp your rental income. Understand what your rental income is, and then start subtracting away everything. Whatever utilities you anticipate on the property, whatever, as I quickly show you guys. Do you want me to quickly show you a calculator? And then you all, what can you see right now?
We see Q&A, creative finance, and underwriting.
Okay, let me pull up and like I have tons of calculators, so this is too easy.
Yeah, you guys will see. Obviously, his calculator will have very similar functionalities to the one that we have in the group. So don't be like, wait a minute, that doesn't look familiar. Whatever calculator you want to use, you have a really good one, a very thorough engineered one, because you are the creative engineer, as they call it. But a calculator is going to be your best friend here. Calculators are always a little scary until you use them 50 times. And then it's like, oh, yeah, this thing is like, I know it like the back of my hand.
Okay, so let me see if I can share this. And then so we'll do this for like a few minutes, and then how do I move you guys? Okay, so this is new, Michael Seller. I started working on a new, I'm really starting to break down my calculator instead of accounting for everything to just specific strategies. So here it is, right? So you have your loan payment. It's the same concepts, right? But now it's more, this is only seller finance. This is only sub 2 is only, so I'm doing that more now.
Can you zoom in on this a little bit more? Maybe like 3 times
I have
bigger?
a super huge monitor, so that's why like I forget how.
It's okay, right? Better. Maybe just a little bit more. Much.
Yeah, of course. Oh wait, I can probably do it. Let's see what I can do is I can share with I can share with my Mac, and that'll make
It's
it
okay. We can see
normal
it. I
size
just
for
know
you.
there might be some people that are like, hey, my eyes escape
No, it's
me.
okay. Rob, it's you. Don't lie.
It is me. I'm getting old. Everything hurts.
Okay, so
Sunit says, can you elaborate on assignment fee? Yes. So an assignment fee is basically a fee. Someone like Mike, he's going to be bringing deals to the group. His team brings deals to the group. And their team spends a lot of time and a lot of money finding these deals. And so they will negotiate them. They'll lock them up. And they'll say, hey, Sunit, I've got this amazing deal that's going to be a 10% or a 15% cash on cash return. And it will cost $5,000 or $10,000 for you to purchase this from me. That assignment fee only matters if you're buying someone else's deal. If you're going out, Sunit, and getting your own deal and negotiating your own deal with like an agent, for example, there will be no assignment fee, but there might be agent commissions.
Can you see the calculator now?
Yes, that's great.
Okay, cool. It's the cost, because think about it, for someone, it's like any product, right? They're selling it to keep their business going. They're selling you the contract and you're paying them for the contract they structured because they had to spend a lot of time and money typically. It's really hard not to spend money when you're trying to wholesale. You're basically compensating them for that. Obviously, they're making more than what they spent. Ideally, otherwise they're not really going to be in business too long. But
Right.
Okay, so once again, let's focus on cash flow. So here's a seller finance deal. This is the loan terms right here, right? Your 798.38 really is what you should focus on. You plug in the purchase price, down payment, whatever, and you're going to get your monthly payment there. Let's say the rental income is $2,500 here on this property. Okay. You have your expenses. You have your seller finance payment, right? This amount, the taxes, the insurance. If there's an HOA, I hope most of y'all are not buying short-term rentals with HOAs because that'll probably make it tough for you. They switch their rules. Utilities, if you're responsible for them, so whatever, water, sewer, electricity, heat, garbage, internet, right? You're covering those as a short-term rental operator. You need to account for utilities. A lot of people do not account for utilities, which is doesn't even make sense because that's $500-$600+ a month. And the nicer, bigger the house, the more the utilities are going to cost you.
Mm-hmm.
And then you have your reserves. So you have your vacancy and maintenance right here. Vacancy, maintenance, and capex. For me, as a long-term rental, this 10% is 10% of this monthly rent is what this amount is. Same with vacancy, it's 8% of this monthly rent. For you all, it's a little different, right? Because your income, when you're doing a short-term rental, your income should already account for your occupancy rate, right? So your income, it could be 50,000 at 100% occupancy, but typically you're going to run it at like 80% occupancy. So you're going to only account for 80% of that income, or however you guys are doing it. And then I include here property management, right? You're going to need property management unless you're self-managing, and I assume most of you are self-managing, at least starting out. And then for me, I include private money lender entry cost financing. So if I have someone else, I'm paying the private money lender is paying for my entry costs, I'm paying them an interest rate return. Don't worry too much about that for the most part. That's, we're not going to talk about other people's money and all that right now. We're talking about, so it's the same thing, right? Your rental income minus all your expenses. And then here's your entry cost. You have your down payment to the seller, right? This $10,000 whoops. I think I broke it earlier. I was literally doing this up until I came in here. Your down payment to the seller. There's no arrears on this one. There's a 2.5% agent commission, which I don't think that one makes sense either. All right, that one makes sense. 2.5% agent commission that you're paying. So maybe it's the seller agent only. You don't need an agent on your side. You're paying the seller's agent. There's no rehab renovation cost, which is not true. If this was a short-term rental, you're going to put in, I don't know, a lot of money. You're going to put in $15,000, $20,000, $25,000 to furnish it out. You have your closing costs. In this scenario, it says 3%. That is extremely high, and that's not even right. 3% times the purchase price, and really it'd be like 2%. That's usually what we put, and you're paying that as the buyer. Your admin, marketing, and exit costs, there's $1,000. The assignment fee, which is like $10,000 on a typical wholesale deal, it's around 10,000. I guess it goes 5,000 on the low end to, I mean, it could be as high as, if the deal is an amazing deal, then you shouldn't care what you're paying the wholesaler, as long as you're still getting the returns that you want.
Mhm.
If the wholesaler is selling you a deal with $100,000 assignment fee and the deal sucks, well, they don't deserve that assignment fee. That's when you negotiate. But and then your carrying costs, which are just 3 months of your monthly costs. And all you're doing is your cash flow, right? Your income minus your expenses, minus your property management, minus your reserves is your cash flow. So it hits my $100 a month. But when I take that monthly cash flow, multiply it by 12, and divide it by these entry costs, I'm under my, here it says 10%. I'm under my 10% cash return. If you're looking for 5%, well, okay, that would work for you. If you're open to a 5% cash return, that would be a deal for you. And then your cap rate, we're not gonna get into that. Don't worry too much about cap rate. It doesn't really
Yeah,
matter.
it won't really apply on a single family home.
No, because you're not going to implement the strategies needed for the cap rate to matter. And then equity, don't worry about that. This is fake because I didn't do the actual, right? I didn't do the actual comping for what the property would be worth. So that one doesn't matter for you. But what we talked about, right? Your cash flow, very straightforward. We went through what makes up, right? Your income is your income, and your expenses are your expenses. You have your reserves, and you have your property management costs. Then you have
And
your
then
cash
basically,
flow, right?
and then
Minus
basically you have
expenses.
your buy box down here, or your criteria for what makes a good deal. And even though it cash flows well, it's below your cash on cash return. So you say, all right, no deal. Move on to the next one.
Yeah. And don't use my numbers. Use whatever makes sense for you, because someone asked about appreciation. How do you know what's a good appreciation market versus not? You can look at historical trends. You can look at, the reason why things go up in value is because there's more supply than there is demand typically, right? So when you're talking about San Diego, and I'm not going to get into the reasons for it, right? Just think there's more people that want to live in San Diego and buy homes and live in San Diego than there are houses available. That's a very easy indicator typically for a market that's going to go up or not. A market that is, like Rob mentioned, out in the middle of Kansas, and there's one economic driver, right? It's this one oil company. That's a really risky investment. I wouldn't bank on anything there. And typically there's a somewhat inverse relationship there. The higher the cash flow, typically the lower the appreciation. Just typically how it works. If you're going to make more money each month, if your rent far exceeds your monthly expenses, which is a indicator of the value of the property, typically it's also not a same market that's going to go up a ton of value because it's cheaper properties, but you'll make more each month. So it depends on your investment. If you want, well, yeah, I'll leave it at that. That's a whole nother training, defining your buy box and why you're investing for what you're investing for.
Yeah.
Cool. And then I'm happy to answer questions or whatever you all want. Oh, yeah. I guess real quickly, let's do the amortization. So in this scenario, this is a $216,000 loan, 30-year amortization term, 2% interest rate. Let's just do like 5%. I'm going to break the code and put 5%. Oh, and the start date is incorrect. Let me fix this real quick. Equals 06. I forgot I changed calculator as well. Sorry, y'all.
This is me and my calculator every day. I'm like, my business partner who makes it is always like, why did you do that? And I'm like, sorry, I didn't mean to break it.
Yeah, so this is already talking about as if you've owned the property. So let's change the interest rate here to 5%. And then let's say your first payment is next month. So it's 2/1/2024. Your seller finance payment is either going to be 30 days from the day you closed, or you agree with the seller. I have one that's like, and I'm cool with it. It's like the 15th of each month is when I owe him. That's the 30 days from when we closed. He wants to get paid. Or you can set it up as like the first of the following month. As Rob mentioned with the sub 2 loan, you're going to make payments on the next day the mortgage is paid, whether you're closing on the 29th of the month or the 1st of the month or the 3rd of the month. You're going to pay that next mortgage payment. Typically, I mean, it could be negotiated, but typically you're going to make that payment. So going to the amortization, your payment is $1,159. That first payment, $900 goes to interest. Let me zoom in a little bit for y'all. Let me zoom in for Rob real fast.
Yeah, I can't see it. What is that?
So $900 is going towards interest and $259 is going towards principal. So that first year, you've paid $3,100 towards principal, or you've made a payment of almost $14,000 in loan payments. Almost $11,000 of that was towards interest, and only $3,100 was towards principal. And let's see how far along this amortization schedule. You're basically paying 50-50. So it's going to take right around, I'm a little too fast for myself. Let's say right around here. It's going to take 17 years and 2 months before making these payments that your interest amount is the same as your principal amount every month that you're paying the loan.
It's crazy.
That's why it takes so long for someone to build equity in real estate unless they hold it long enough, or if the property appreciates over a long enough time period. That's the other factor, right? Your property is also going up in value at the same time, typically over a long time horizon. But as you'll see, that's an exact inverse relationship. So at the end, the majority is going towards principal and very little is going towards interest. And that's the way amortization schedules work. If it was every single month, the same amount is going towards principal and interest, that'd be, I think it's called like a fee simple, whatever, interest payment. But all loans are all residential loans are amortized over some number of time, and they go over the same cycle. There's that inverse relationship between principal and interest payments.
Yeah, I might be a little psychotic here, but I actually have a couple of properties, like my property in LA and then my Joshua Tree property, where I pay an extra $1,000 to my principal every single month, just because I can. And good investors and like hardcore investors would be like, "You're an idiot. Invest that over there and make an ROI on that $1,000." And I'm like, honestly, it's really nice to see my debt pay down, like go down that way. And like, I just obviously won't pay as much in interest in the long run, but I'm like really aggressive in some aspects of my real estate journey, but I'm also really conservative in others. And I love paying down debt. It feels really great whenever you actually make progress in the year. And that's that property that I've paid an extra $1,000 to every single month. Every time I log into the bank account, I'm like, oh, wow, I've actually made a dent on this property. And I've owned that one for, like 7 years now.
Well, and it makes insane savings. That $1,000 doesn't just save you $1,000 of interest. It saves, like, let's say you paid an extra $1,000 in this scenario. So your payment is always going to be the same. Okay. So in this scenario, I don't know what that was on, but you save $3,400. Let's say you do that. Oh, well, part of this is it's relatively low interest and a low loan amount. So
yeah, so
every month you pay an extra. Yeah, if it's a big loan amount, it's going to make a much bigger difference.
Yeah, $624K is that one.
So $4,000 of extra principal payments has saved you $13,000 of interest over the life of the loan, right? That's pretty awesome. Like, it's got a compounding effect because of the interest. Yeah, and you're right, Rob. A lot of investors will say you're doing the wrong thing because you could use that money to scale your portfolio, buy more properties, but there's psychological benefits of owning or paying down your debts. And if your interest rate is 8% and you're guaranteed every month, like the more you're paying down towards your principal, you're paying down more of that high interest debt, that's worthwhile. When it's 2, 3, 4%, it's questionable because can you make more than that? Right?
Yeah.
Then it really is more of a psychological than financial thing. But teach their own. That's why it's so important to understand where you're at in your investing journey, and it's going to change over time. I was super cash flow and still very cash flow, but more focused on other benefits of real estate, including paying down extra debt. You know, that's something I'd consider now as opposed to buying things 100% loan to value just so I can scale my portfolio faster. It just depends on what you're looking for at the time.
Yeah. Cash
Cool,
flow had its time and its place in my life. Obviously, we all want it. We all need it. But when I look at how much money my net worth has grown because of the equity in my portfolio versus the cash flow, they're not even comparable. Like my portfolio has appreciated multi-millions at this point, and that's way more than I've made from cash flow. So when I made that click where I was like, oh, my equity or my debt pay down and my equity and appreciation is 3 times greater than my cash flow, I was just like, oh, that's great. That's all I ever want now.
Mm-hmm. And cash flow is taxable. Probably not because you're going to have depreciation benefits, but that's taxable. Whereas as you build equity and properties, that's not taxable unless you decide to sell.
Yeah.
Right. And then you get 1031 it and there's tax benefits there. But there's a saying that cash flow makes you rich and equity makes you wealthy.
Mm-hmm.
Right. So you got to own these properties for a long enough time for it to appreciate and pay down the debts to become wealthy. But you're going to need cash flow to get rich and at least cover your needs. You know, if you're trying to quit your W-2 job, having equity is not going to change that necessarily. I mean, I guess you could sell it, but it's really that cash flow that's going to help you do that.
Yep. Yeah.
Cool,
cash flow makes you rich, which is temporary, but you know, wealth is forever. I think that's the idea. And if you got a big, you know, like Mike, you've gotten $6 million of property in the last, I think you said 12 to 18 months. That's crazy, man. If you did that every 12 to 18 months, 10 years from now, like your assets are like $60 million. And then 30 years from now, they're worth double that and paid off. It's like, it grows so fast once you kind of figure out some of the levers that you can pull in this game.
Yeah, one of my other mentors, just to highlight, right? I'm talking about what I've been able to do, right? In 9 months, almost $7 million of real estate. But like, you don't need that, right? 1, 2 properties is life changing. If you have a property that's generating you a couple $1,000s a month, and then the loan's paid off, and then now you have that, you're already so far ahead of the majority of people who don't have that type of income stream. They have to constantly trade away time for money, right? So don't worry too much about, the only competition is with where you are at and where you're currently at and where you want to be, not where I'm at, where Rob's at, where anyone's at. Who cares? You just need the next one, right? And then you want to make sure that you're not so focused on comparing to others that you're buying shitty deals. The thing that's so dumb is when you go to meetups and everyone's talking about how many units do you own? How many units do you own? I mentioned these statistics like property value, ownership, and number of doors. Who gives a shit? Because if I'm losing $2,000 a month, who cares how many units I have, right? It's really, is the portfolio that you're setting up leading you towards the goals that you want in life, right? That's way more important, and just working towards that than the number of doors. And yeah, honestly, cash flow is more important than the number of doors, because you can have 10 doors that make you no money or 1 door that makes you $2,000, right? So the competition with yourself, that's the cool part.
Yeah, I love it. Yeah, I think everyone here, like, we don't have to rush to buy $6 million of real estate. I think make a goal. And there's some of you, I've already spoken to a few of you that are like very ambitious, and like there are people that are closing on properties already and making offers. But remember, just a fair thing for everybody to remember here. 1 house a year for the rest of your life will make you so wealthy by the time you retire. So it's not a sprint, it's a marathon. I've set this whole thing up to give us a timeline to sprint, but the idea is you then, you know, after this is all over, have the principles of like, okay, I know the strategies to get 1 house every month, or sorry, 1 house every year. And then some of you are obviously a little bit more tenacious and ambitious, and maybe that means 2 a year. 2 houses a year for 10 years, you're going to have 20 houses 10 years from now. That is so much. And again, it isn't about the door count. It's more about finding houses that fit your buy box, things that you like. maybe cash flow is important, maybe appreciation is important, but I think the moral of the story is if you're just slowly building, 10 years from now, your whole life is just going to be very different. So don't focus on the number. Don't focus on the door count. Just focus on building a portfolio that you really like, that fits your investment preferences and your philosophies. And in 10 years from now, it's like you're going to be so happy that you got started today. You've got time. Everyone here has time. Don't ever feel like you don't have the time to do it. And my dad always told me growing up, there's always a deal everywhere. I would always get bummed when the stuff that I wanted got purchased. I was always like, it's gone, Dad. He's like, there's a deal everywhere. There's hundreds of millions of houses in the US. They exist out there. So just know you've got options. You've got time. Take it slowly. I appreciate everything you've shared with us today, Mike. You want to do a little bit of Q&A before we cut everyone loose?
Yeah, that works for me. I can talk underwriting. I can talk whatever you all, creative financing, whatever you all are interested in.
Let's see, Roy. Yeah, what's up, Roy?
Roy, last question though. Just kidding.
Yeah. I jumped to ask. Yeah, there's a possibility I want to learn. So thank you. I'm curious. Like, do you got this growth from you will give it to the wholesaling part, or is it just like you received enough rent to grow so fast? Like, because this is why I jump into Airbnb because I feel like with normal rent, only when I be very old I can enjoy the financial freedom. This is what I believe. So I wanted to jump into Airbnb to do it faster. How did you did it so fast?
So this is why I like to highlight kind of my timeline from 2018 to all those things. The reason why I grew so fast is because I grew relatively slow. So I focused on one skill set at a time. For me, it was I want to buy a multifamily property at house hacking and lower my monthly expenses. So I got really good at that. And then I did it again. And in that meanwhile, I was underwriting every single deal. Then I started getting into wholesaling. Okay, I'm going to get really good at talking to sellers. And I'm going to get really good at underwriting cash deals and then finding buyers for them. And then it was I'm going to send letters to sellers and start structuring seller financing deals. And then I joined Sub 2, and that's a good mentorship, but it wasn't necessarily anything you're taught there. It was a few little missing pieces that I needed to then really explode my investing journey. But it has to do with building one skill set at a time and get really, really good at it and focus on that. For me, there's nothing more important than being able to underwrite deals and know what you're getting into. Because as Rob mentioned, and as others I mentioned, I think Brian commented here too, there's no shortage of properties out there. Your job is to be able to filter what are the good ones and the bad ones. Regardless of creative financing, conventional financing, cash, who cares? Your job is to understand what is actually working towards your goals and what isn't. So for me, what worked well is really developing my skill sets, leveraging my network and connecting with a lot of people, and then taking the combination of creative financing, right, and finding my own deals as well as buying deals from others and using other people's money to buy those deals. If I had to use only my own money, I couldn't scale at the pace that I did. But because I had the experience and knowledge to be able to find great deals and then bring capital partners who also wanted to be part of those deals or wanted fixed interest rate returns, I was able to buy a lot more than I ever could with my own money. Right? I actually don't even use any of my own money for real estate. I've used maybe less than $25,000 for my whole portfolio that I ever used in my own money. Everything else has always been other people's money or really low down payment house hacking.
That's crazy. 25K.
It's other people's money. That's the secret. That's what it was.
Yeah. I mean, that's how I scaled up too. OPM partnering. I ran out of money. Like the thing is, guys, when you have a really good skill set, when you show that you're smart at this, like when you know your stuff, and then you have a really good deal, it's really easy to go out there and say, all right, Mike, I've got this insane deal. It's 10 grand down, 20 grand down, whatever. It's going to do this as a cash on cash return. If you can fund it, I will run it. If you're the bankroll, I'll be the brains. And here's how this investment should play out over the next 10, 15, 20 years. Most people who have money, like maybe it's like a high W-2 earner or whatever, they don't have the time to get into real estate, but you do. Mm-hmm. And so they're happy to kind of back that horse if you can come to them with like a really sort of educated thesis and analysis on a property.
And that's like a big part of it. Oh, Rob, say hi real fast.
Hi. Please. Hello.
All right, cool. I got a photo. I always forget and it's too late.
Tag me.
Yeah, so I always say there's three things to every single transaction occurring, right? You're going to need deal, you're going to need money, or you're going to need the deal itself or hustle, right? Someone's got to find that deal, structure that deal. You're going to need the money to acquire that deal, and you're going to need the experience to make sure everything happens and it's a good deal. So over time, when you're starting out, you have all three. Typically, you're doing all three of it. Sometimes you can get money from someone who's interested in working with you because of who you are, your reputation, your credibility. Over time, you can then leverage your experience to be the one buying all these deals because of you have a solid understanding of the deal, if what is a good deal and what isn't. You can buy deals from others, you can create your own deals, and then you're using other people's money to buy those deals. But typically when you're starting out, you have to start with the foundation, try to build on those. And sometimes you can, if you find a great deal, you can typically find someone who's got money who wants to work with you on that deal as a partner. Mm-hmm. Especially when you say, oh yeah, I'm part of Rob's community.
It does help. It does help when people know that you've invested in your education. It's a little easier because they know you take it seriously. Okay, Mona says, great info. Thanks for sharing. Could you touch on how you take into account the tax benefits, cost segregation, etc., when you're underwriting your deals?
So
how do you
we
do
are
that?
We are not on the calculations that I showed. That would be probably the next version of this. It's just focused on cash flow, cash return, really trying to understand the different loan types and then the different entry costs associated with it. But on my calculator, well, shit. Here's another version of my calculator. What screen am I showing? Can you all see this?
Mm-hmm.
Is it really hard again? So on my calculator, I'm also accounting for whether I have a private money partner or not. Let's just say, let's switch these numbers to 100 and 100. So I'm saying, well, that's a really low entry cost. This is a bad example. But, right, you get your annual cash flow. You get your principal pay down, right? That's a tangible benefit added to your network every single year. And it only goes up over time. That's the cool part. Your interest pay down. So interest is never paid down, but interest payments on real estate is tax deductible, right? So you get the benefits of tax deduction on interest. You get depreciation. As you mentioned, I put the 27.5 years. I like to cost seg. Actually, Rob, thanks for sharing your short-term rental hookup or your cost seg hookup. So we like to depreciate properties, accelerate depreciation on those, and get those additional tax benefits. And then just assuming a 3% interest return, that's how I calculate all this. The depreciation is a little disingenuous because this depreciation is the amount you'd be able to depreciate of your taxes or write off, right? But it's really gonna be dependent on your tax rate that you're paying at the highest. What is the highest tax rate that you're paying? That's where the depreciation, that's 6981. Let's say you're in a 32% tax bracket, right? You're going to benefit 2,200, right, of that, 32% of that, right? Because that's the write-off of it, right? Does that answer your question a little bit?
Yeah, it gets a little finicky. We're trying to figure that out on the calculator, how to do the cost seg calculation, because on a straight line depreciation, which is how you should do it, in my opinion, like you should just do the straight line so you kind of understand. But if you do cost seg, then that straight line depreciation of like 6981 could very easily be like 60,000, right? And then it just changes the numbers. But we're still trying to figure out how to make that work in the actual calculator because it's kind of hard. It's cost segs are a really weird thing to put in a spreadsheet, but certainly there's a way. But we usually just keep it the straight line depreciation.
And remember that you will not get whatever the depreciation is, you will not get that directly. You get a percentage of that based on the tax bracket that you're paying in. And secondarily, not everyone qualifies to take that loss, right? You can't take that full loss unless you have the short-term rental loophole and you're the one managing it and doing 250 hours, or you or your partner is a real estate professional. No, you or your spouse, right? Your married spouse is a real estate professional. That's what I have. My wife is a real estate professional. Like, so you need to qualify to even get those benefits to at least offset, right? More often than not, this straight line depreciation is all you're going to need to offset your, like, this 2,200 offsets my $1,700 in cash flow a year.
Yeah.
Right.
Yeah.
So I don't need to bonus depreciate. But if I wanted to take that and reduce my tax liability on my other income streams, I now can, because I have a real estate professional wife. So it makes sense to maximize my depreciation on that. Right.
Yeah.
So that's a big factor of it.
Yeah. I do want to punch in on that, but we'll be opening up another can of tax worms. But Jonathan does say, how do you get the land versus building for estimating depreciation? There's a couple of ways you can do that. You can go to, and it's not always going to be this way, but if you go to like redfin.com and then you go to the tax history, let me see if I can just like pull it up really fast to show you.
I just 80% it. I mean, that's what I do.
Yeah, you can do
for,
that.
For a quick analysis. I mean, I'm not saying that's what you're actually going to get. Talk to your CPA, but I just 80% it.
Okay. There. Yeah. Let me see if I can find one really fast.
Your property taxes will say what the land value is versus the improvement value of the property value. Take that ratio as a good. And if you're somewhere like California where the land is worth a lot, well, that sucks. Whereas you're somewhere like Alaska where the property is the only thing that has value, no one cares about the land, well, you're getting a lot more depreciation for that.
Yeah, this really shouldn't be so. Okay, I promise. It's not usually this hard. I'm just looking in all the wrong cities, but hold on.
Awesome, Mona. Great. How do you get land versus Mike? What's the difference between your free and paid?
I did it.
If you want the free calculator, download that soon because I'm probably not going to have the free calculator moving forward. So download that. Go to my Instagram, Michael MNAT, and download that free calculator. Create a finance calculator. The paid calculator has a bunch more automations incorporated into it, and like I won't get into it too much. I'm not trying to advertise it right now. But and then it has like these kinds of things. You know, it's got this, you know, private money partner breakdown analysis. It's going to have more exit strategies incorporated in there. So as I mentioned, I'm actually doing something totally different. Instead of one huge calculator, it's going to be like components of calculators moving forward. So if you want to grab my free copy, please do so. Now it's on my Instagram. There's a link there.
Okay, what is your Instagram so people have it?
Yeah, so it's Michael MNAT. Actually, what do I do with? Oh, let's do this. Can you see this, or can I see the window? Oh.
We can see you typing in it, but we don't see anything quite yet. Let me see. Okay. I got you right here. I'll toss it in the chat for everybody.
Yeah, I included it in there, but I didn't. Got some fun stuff going on there. And one of my goals is to very much focus on social media and branding and content this year. So I'm going to be providing even more value than before because I'm kind of a silent lurker. I just kind of do my job. I do my work, and then I don't really talk about it much. But this year I'm definitely doing a lot more of that. So especially if you're interested in creative financing, deal underwriting, things like that, free trainings, definitely stay involved on social media, primarily Instagram and then YouTube. So I'm putting a lot of underwriting on there as well.
Cool. Yeah, we should do I'll hit you up about some content. Okay, so I want to just kind of break this down really fast. Someone said, how can I find the land versus the depreciation? So most of the time on Redfin, if you go to a property, I just found one in Hermitage, Tennessee, go to sale and tax. Okay. You're going to see land in addition and then the assessed value. So what you're going to do is you're going to try to find, you cannot depreciate land. So you are going to try to find the ratio of how much the land is worth relative to the assessed value. So in this capacity, well, I guess you could do the addition. The addition is the improvement. That's the building. That's what you can depreciate. So you would say 45,850 divided by 58,350. And your, this is actually funny because it's pretty close to 80%, but 79% is the improvement value of this house. So now what you would do is you would take this 0.78 number and you would multiply it times this number right here, which would be $339,900. And that's $267,000 that you could kind of start to depreciate and run a cost egg on and all that good stuff. Someone else mentioned you could go to the GIS. That's actually the most this all pulls in the information from the GIS of Hermitage, Tennessee is my guess. But yeah, you would go to the GIS and type in like Hermitage. Let's see. This is such a weird Hermitage, Tennessee GIS. And then you would look up the actual parcel that's officially listed, and they'll give you the official breakdown too. So there's a couple ways to do it, but the quick and easy way for me has always been using the Redfin. I think Zillow might do it too, but Redfin in most states has that information accessible for you.
Yeah, and I've seen right around 75 to 85% typically.
But it's not always like that, because sometimes, like you said, in California, I remember I did a cost egg on my property in LA, and I was like, all right, $624,000, baby. I'm so ready to depreciate this. And the land was worth 75%, and the dwelling was worth 25%. So I was only able to cost egg like, I don't know, 150K versus, the whole $624,000 basis price. Okay. Anything else? Anybody want to raise their hand? Anyone have a question? Anything like that? Jesse says, I would like to get back into Alaska as an investor. Where do you feel like the opportunity would be best with the current market situation there?
Great question, Jesse. I don't know. I'm not actively buying any deals in Alaska. I would, but yeah, Alaska just got its own problems. Primarily, my focus of not wanting to be involved with the management at all. It's really hard in Alaska. There's only so many property managers, especially in Fairbanks. Anchorage, I'm open to it, but it just depends. The thing with Alaska is you're going to get way more cash flow. Your cash flow to appreciation scale, right? Way more cash flow heavy as opposed to appreciation. But with high interest rates, unless you're getting a good creative deal, it doesn't make a lot of sense at current interest rates. And the hard part with Alaska, it's a non-disclosure state, so you don't actually know the price the previous house was sold for. So it makes it a little bit harder to then structure creative deals or off-market deals. I mean, I've done it, but it's just more challenging. And most of the people that I work with now to buy deals from, most people are not marketing Alaska. So if you want to go off-market there, you probably have a good shot, less competition. So.
Okay. Brian's raising his hand.
Brian, yeah.
Is it Baker or it is Baker, right?
Yep.
Okay, cool.
So I have a question. It's a personal question. You're still in the military? Or are you on active duty?
No, I got out in 2022, summer of 2022. So I've been out for a year and a half now. Pretty crazy.
Were you active or guard and reserve? Yeah. Were you active or guard and reserve?
No, I was active duty. I was stationed up in Fairbanks, Alaska, as my last duty station. That's when I got.
And you were an officer based on a picture I saw, I think, on your Instagram.
Yeah, definitely.
So
I was an environmental science and engineering officer for the Army.
Okay. How on earth did you manage all of these real estate acquisitions while you were on active duty?
Well, I bought a duplex my first year, in 2020 there. 2021, I bought a 4-unit, and then I started sending letters out in my local market to reach out to a title company and said, hey, title company, can you tell me people who don't have loans on their multifamily properties? And I talked to them, was nice to them, and they offered me a list before I knew you could just buy lists. So I worked with my title company to get that list, and I sent letters out to every single multifamily homeowner there that owned their properties outright, and just started talking to them all and structured creative finance deals. And then, that was it. I mean, that was my Alaska journey before coming back down to San Diego and really growing more after that. But I mean, even just one of those deals itself is just a small, you guys are short-term rental group. You're not really looking at your owner occupied and all that, but that's the idea. Like 1 or 2 properties can really change your financial trajectory forever. Right. Like now we're talking extremes with some of us, with some of our portfolios, but it's like, that's not necessary. The cool part is just taking that action, being in the right rooms, and then buying things that don't set you back. That's the one that breaks my heart, but I don't know what to do once it's too late. sometimes people just need to cut their losses and sell a bad deal that they got into. But it's much better when you plan ahead rather than deal with the aftermath of a bad deal.
Yeah, cool. No, thanks. I appreciate it.
Let's see. As a Californian myself, good affordable creative deals may be difficult to find. Do you feel that way? Are you able to find deals in San Diego/California?
Yes, but typically they're going to have higher entry costs. Let me see if I can show you one of my coolest houses in California. Like I bought, Cease, do we have any? Okay, well I have this. You won't be able to hear it, but
I always thought that it would give you the opportunity to do the sound, but I don't know.
I'll show you one of the coolest properties. This one, I bought 2 deals in the last year in California. But usually you're going to have higher entry costs, right? They're not going to cash flow as well, right? There's a lot of issues with it. So we bought this one. You can see this guy bought it. He bought the property for $1.8 million, right? And actually there was a silent second loan on there, so he got money from elsewhere. And then when he tried to sell it a year ago because he couldn't operate it well, he had really immature operators in place managing it. He tried listing it for 2.1, 1.9, and this is basically the price he got to, where if he sold it for much less because of how expensive closing costs are on the acquisition and the sale and the silent second position, the private money loan, let's say he had in the back end, he would have had to pay significant amount of money to sell it. So we're able to buy this deal for the loan amount itself and then taking over the existing loan that he had in place with the second position loan in place, which was great for me because I didn't have to go raise money from someone else. And I told him, hey, if you want me to do this, you got to do it at a much lower interest rate. So I had a bunch of negotiation ability there. But yeah, so you can do it. It is really hard. And if it's a really great deal in California, most people don't, it's going to cost you a premium, whether it's the seller's going to need a lot of money. The agent's going to get a high percentage for their commission. The wholesaler's going to want a lot of money out of it, so it just starts really costing a lot. So you have to have a lot of money for those entry costs. Plus then furnishing a house like this or an expensive house as a short-term rental, it's one thing to furnish a 1-bedroom, 1-bath condo, right? It's another thing when it's a big old house. It's going to cost you a ton of money to do that. So yeah, it's just a different ball game. It's a different ball game than a lot of my portfolio, these types of deals.
Yeah,
but it's
I like it,
usually the same thing: low equity on markets that are not selling at the price the seller needs them to sell. So yeah. I did 2 last year.
We're going to be getting into some of that in the program too, kind of figuring out how to get some of these. I mean, there's really 2 main components to Creative Camp, which is like we have like our deal pipeline where we have our wholesalers working to provide deals. And then we have sort of the education on how to go hunting. And I think that's like 50-50 on the group. On some people are like happy with the deals getting served to them. The other people are like, man, I want to make phone calls on some of these houses, some of these $1.7 million houses in San Diego. So I'm excited to do it. We'll probably do a call if you're down for it sometime in the future, in the next month or so, doing a call on maybe agent outreach, how you actually script some of this, how you're able to like negotiate some of this stuff. Cause you've taken down some pretty cool deals.
Yeah, I'm happy to. I'm in that camp now where I much prefer to buy deals from others because of the time and effort that it takes to find your own deals. Because there's so many no's and so much cost associated with it if you're doing it right. And it's really hard to compete with someone who is doing it right. So I'm just kind of showing you the house, but with someone who is doing it right, like has pulling the right list, they have people on their team to make these calls. But yeah, I'm in the camp that I would much rather rent, or I'd much rather buy from other people than generate my own deals. But there are certain deals that only I structure because I couldn't get a deal. Like I couldn't get these big deals. So I'm happy to do it. I mean, I've done it over and over again. for creative deals, cash deals, whatever. It's fun. It's
I
fun.
mean,
Like that's part of it.
this is
The
the crazy
structure in
thing. Just a little encouragement. I hope that there's some people here that have, I mean, we just did a mini masterclass with Mike here on seller finance, sub 2, hybrid. We're going to be beating you up with these terms over and over and over again. Hopefully, if this is you, I would love to hear from you in the comments. Who here about a week ago, because we've only been doing this for a week, who here a week ago was on that call with Drew Arriaga in the Q&A, the power hour, and y'all were like, oh, what's happening? I don't understand. And then today you're like, oh, I think I'm starting to understand sub 2 and seller finance and creative finance. If that's you, I'd love to hear from you. I've actually spoken to a few of you that were like, at first it was scary and now I think I get it. And I say this because we're in this thing for like a week now, and we just Taylor Smith just submitted his EMD on a property today. Angel Aguilar just got a deal today from the deal pipeline. Sarah Howard also accepted a deal today from the deal pipeline. And then Scott Edwards didn't get something technically from our deal pipeline, I don't think, but he made 2 phone calls in the last week on seller financing, and he got both of them locked down. So it's kind of crazy. I don't think he said he was walking with his wife down the street. I guess they were going to school to drop their kids off. And then his wife was like, I want that house. Buy that house for me. Jokingly or whatever. And he was like, all right, I'll call. And he called and he submitted a seller finance offer and locked it up. And they're going to go and live in it now. And now they're going to move out of their 5-bedroom house in Austin, Texas, and Airbnb that. So it's just kind of funny. Like, sometimes it's super fast. Obviously, it's not really ever going to be a 2 phone call thing and you close 2 deals, but it is possible. You won't really ever know until you pick up the phone and make the damn call, which is what I'm going to be saying this whole camp. But I guess what I'm getting at is in the last day, we've had 4 deals locked up. And it's pretty cool. It's pretty cool, guys. We're in week 1 of this thing, and we've already got people moving into their deals and everything like that. So more on that to come. Mike, we'll have people reach out to you on Instagram to connect with you. Go follow Mike. He should get at a minimum 42 new followers tonight. And then you're in the Facebook group as well, or you're in the Slack group as well. Yeah.
Yeah.
Okay, cool. So if you guys ever want to connect with them, he's got an amazing team, really, really cool content and value provide, my friend. So thank you so much. And we'll see you soon on another call. We'll do this again.
Definitely.
You like us?
Yeah, definitely. We'll go more advanced next month into really understanding how you can, the reason why I focus this on you guys, because you're going to receive, at least for now, your skill set should be focused on how do you underwrite deals that are already locked up, right? You're going to just plug in the numbers and understand, okay, this is what the deal looks like. Maybe if the interest rate was a little lower or the sign fee was a little lower, but you're not worried about structuring deals and now you're going to try to negotiate with someone. That'll come with time. Your focus should be understanding how simple it is, right? It's the same thing as underwriting conventional deals, but now you just have slightly different loan products that you're working with. But it's kind of the same thing, just another monthly expense you have to account for. And we'll get more advanced as we go on. So this is just the start of your learning. So keep learning, keep taking action. That's the big one. So
keep learning, keep taking action. All right. I love it, man. Well, thank you so much. We appreciate you. Everybody go turn off your water valves and make sure that you're prepared for the freeze. I was actually really nervous that you guys were going to think that like there's been water dripping in the background. I was like, I hope they don't hear that and think that someone's just like using the bathroom in the background, but all the pipes around me at the current moment are all on right now. So I'm going to go prepare. Everybody call your handyman, get stuff taken care of, get stuff insulated, and we will catch you guys in tomorrow's coaching call with me. And I'm going to teach you air DNA and how to like work through numbers and how to analyze stuff. And you guys can ask questions, and yeah, we'll take down a property together. Okay. Have a